So we often get asked by people, should we form a company? It's a very good first question. Our advice on that generally is driven by commercial considerations, but also there are tax considerations. On the tax side, companies at the moment have a lower tax rate than individuals, so 28% at the moment relative to 33% top rate for individuals makes companies quite attractive. However, you can't just assume that that 28% is the end of the story, because clearly you're going to have to pay yourself out of the company, and so your personal income will be taxed at your own rate. But if you're looking at setting up a business that's going to expand and reinvest a lot of its profits, you probably would prefer to have a company than operate as a partnership or a sole trader. And especially if you're looking to bring in fellow investors, so buying some shares in your company, then obviously the company route is quite attractive. New Zealand does not have a capital gains tax, and so if you are looking at a business such as a Trade Me, the next Trade Me of this world, then you may well obviously want to have a company structure and hopefully in time sell those shares off at a tax-free capital gain. That's the upside of companies. On the downside, once you've got a company, you've got issues such as fringe benefit tax to worry about, the annual filing requirements, separate tax returns. They are much more expensive. They're like children. Having created them, you have to look after them. I've had situations where small businesses have gone ahead and just formed a company without really realising that companies take quite a lot of time to administer. You have to file separate tax returns, prepare accounts and all the rest of it. And often it's better for them just to stay as a self-employed or sole trader person. In other circumstances, people have gone off and got into quite risky businesses as a sole trader, and then have then found that they've got legal liabilities which they would prefer to have been able to shelter behind a company for. So it all depends on exactly what you're getting into. Tax is generally a secondary consideration, not a primary consideration. If you're a sole trader wanting to ensure that you minimise your tax, one of the key things you should do is make sure that your borrowings, most people have got borrowings, typically against their house, you really want to get as much of your borrowings as possible against your business income, because then you can deduct the interest absolutely legally, whereas as we all know, the interest on our own home mortgages is not deductible. And the most common mistake I see small businesses making is to have their own private debt against their own property, but they have equity, their own money tied up in their own business. They're better to try and structure that in a way that ensures that they match the borrowings against their business assets and can deduct the interest, because that can save them up to a third of the interest cost. So that's such a basic but fundamental point, so often overlooked. The same basic rules will apply to partnerships as to sole traders. That is, your tax basically in your own name on your share of the profits, but again, making sure that you maximise the deductions that you could take. And we often see examples of people in partnerships or on sole traders that don't realise that they are able to deduct legitimately all the expenses that relate to that business activity. Small businesses, like big businesses, want to minimise the tax they pay, but in my experience, everyone's pretty honest. They want to pay the amount of tax that they have to pay, but no more, no less. And the best way of doing that, if you're a small business to start with, is just to make sure that your business structure lines up with your own personal family circumstances and with your commercial objectives. And what I mean by that is that you don't want to rush off and form a company unless you really have to. It may well be best just to operate as a sole trader, for example. So the best advice around minimising tax is to get your commercial objectives lined up with your tax objectives. It's actually very rare that you'll be doing something for tax reasons alone, and in fact if you are, you probably really want to push back and ask your accountant or whoever's advising you, should I really be doing this? I think the advice I would give to someone coming to me saying, what are the 3 top things from a tax perspective I should do now that I'm setting up my own business? Number 1 is be absolutely clear about what you're trying to achieve with your commercial operation. Only when we've got that information can we talk about tax. So that's the first bit, be clear, because often, surprisingly, people are not. The second thing is to make sure that you do legitimately maximise the deductions against your income, the interest expense on your borrowings, genuine expenses relating to the business. And the third one is to make sure that your structure accommodates your own family and their circumstances, because they're what really matters in most people's lives, and you want to make sure that you can deliver the benefits of your hard work to them in a tax-paid way, but with tax minimised. And often, for example, using a trust to own your company will be a good way of ensuring that that objective is achieved.